Welcome back to Talk Tickers. And today, well, we're staring directly into the sun.
Or maybe into the abyss.
Or the abyss, yeah, depending on when you bought the stock we're covering. We were talking about Fabrinet, ticker symbol FN. And if you've glanced at your screen today, February 3rd, 2026, you might need a stiff drink.
It is definitely a sea of red out there for this name. It's one of those days where the market reaction just feels completely detached from the business reality.
Detached is a polite way of putting it. I'd call it a paradox. We're looking at a company that just reported what on paper looks like a perfect quarter.
Right.
Record revenue, record earnings, they raised guidance, and yet the stock is currently bleeding out, down nearly 17% intraday.
It's a violent move.
It's a massacre. So the mission for this deep dive is simple. We need to figure out how a company grows revenue 36% and gets punished for it.
Right.
Is the market seeing something that we aren't? Or is this just, a huge psychological game?
I think it's almost certainly the latter. But to understand why, we have to look past the ticker price. We need to unpack this high-performance computing ramp.
Okay.
And we absolutely need to talk about capacity. Because there's a story in this earnings call about the CEO losing his office that I think explains the whole bull case.
The homeless CEO. I saw that note in the transcript, and I honestly thought it was a joke.
Oh, it's definitely not a joke. It's probably the most important indicator in the entire report.
All right, we'll get to the furniture arrangements later. Let's start with the crime scene. The results snapshot. Give us the headline numbers. Was there a miss hidden somewhere?
That's the thing. There wasn't. The numbers were just objectively strong. Revenue hit a record $1.13 billion.
Okay.
That's up 36% from this time last year. But what's really impressive, it's up 16% just from last quarter. They beat consensus.
So they sold more stuff than expected. What about profit? Did they burn a ton of cash to get that growth?
Not at all. Non-GAAP earnings per share came in at $3.36. The street was looking for, around $3.25?
So a solid beat there to
A solid beat. And the margins held firm. Gross margin was 12.4%, basically flat year over year, and operating margin actually ticked up to 10.9%.
Okay, pause on that. Operating margin ticking up. In plain English, why does that matter?
It's operating leverage. It's the magic that happens when you pay for the factory once, but you crank out double the product,
Right.
Your fixed costs, the rent, the lights, they stay pretty flat, but your revenue explodes. So that extra money flows almost straight to the bottom line. It means they're getting more efficient as they get bigger.
Got it. So they're making more money on every extra dollar they bring in. That sounds good.
It's very good.
Okay, so beat on the top line, gate on the bottom line, better efficiency. Usually when a stock crashes like this, it's because the guidance was terrible.
Right.
Did they guide down?
Nope. They actually raised guidance. They're projecting Q3 revenue to be between 1.15 and 1.2 billion.
So more growth.
Continued sequential growth. And they guided EPS up too to a range of 345 to 360. They're telling us this isn't stopping.
All right, I'm playing the angry investor here. You have a beat, a raise, record numbers, and the market just wiped out $1 billion of value in 6 hours. What are we missing?
You're not missing anything in the numbers. You're missing the context of the calendar. You have to remember, this stock was up about 87% over the last year.
Yearly doubled.
Right. So when a stock runs that hot, it gets what we call priced for perfection. The market didn't just want a beat. They wanted a miracle.
So very good is actually seen as disappointing.
Exactly. It's like getting an A- when your parents expected an A+. You still get grounded. It's a valuation reset, not a business failure. But if we stop staring at the stock price and look at the engine room, the story is actually getting better. We have to talk about the non-optical segment.
Right, the confusingly named bucket where they hide the AI stuff. High-performance computing, HPC. How did that do?
This is the star player of the quarter, and frankly, the numbers are startling. In Q1, this HPC segment did about $15 million in revenue.
15.
In Q2, the quarter they just reported, it soared to $86 million.
Whoa, from 15 to 86 million in 3 months. That's not a ramp, that's a vertical line.
It's massive velocity. And on the call, management was pretty specific. The CEO, Seamus Grady, said they are a little more than halfway ramped on this program.
And what does that mean in terms of dollars?
It means they expect the revenue run rate to exceed $150 million a quarter once they're fully up to speed.
$150 million a quarter. That's $600 million a year from just one program. But they said they're a second source, right?
Yes.
To me, second source sounds like you're the backup plan, the understudy. Why is that exciting?
That's the wrong way to look at it in high-end manufacturing. Being the second source isn't being the understudy. It's being the foot in the door.
Explain that.
There's an incumbent manufacturer who has most of the business now, but the customer, who we can assume is a huge AI player, brought Fabrinet in for a reason.
Because the first guy is messing up.
Or can't scale fast enough, yeah. Grady basically said that if they can beat the incumbent on quality and delivery, they can win a larger piece of the pie. They're the predator here. They're inside the house now.
Okay, so the AI story is real and ramping hard, but this is still an optical company. They did over $500 million in telecom revenue.
A record $554 million in telecom, up 59% year over year, which is just staggering growth for what's supposed to be a boring sector.
But is it boring? Or is it also just AI in disguise?
That's the nuance. A huge chunk of that growth is coming from DCI data center interconnect.
Right, DCI. It sounds like plumbing.
It kind of is, but for data centers, it's the super high-speed optical links that connect all the computers in an AI cluster so they can act like one giant brain.
Without DCI, your supercomputer is just a warehouse full of lonely laptops.
Precisely. And Fabrinet's DCI revenue grew 42% year over year. They're talking 400 ZR, 800 ZR. This is the nervous system of AI.
So even the legacy business is an AI play.
It is, and management said demand remains very robust.
Okay, skeptic hat on again. Datacom revenue was actually down 7% year over year. Why is that shrinking if demand is so hot?
That's a great catch. The issue, there wasn't a lack of orders, it was a lack of parts, specifically EML lasers.
EML lasers.
You literally cannot build an 800 gig transceiver without one. It's the light source. And there's been a global shortage.
So it's like trying to sell a Ferrari, but you can't get spark plugs.
Exactly. But, and this is why you listen to the earnings call, management confirmed they found a fix. They got a second source approved for those lasers during the quarter.
There's that phrase again, second source.
Right. It means they found a new supplier. This unlocks the supply constraints for Q3 and beyond. So the one drag on their growth is now being resolved.
Okay, so the AI ramp, the DCI boom, the laser shortage is fixed. But my favorite part is the building. You can fake a spreadsheet, but you can't fake a 2 million square foot building.
This asset expansion program is just, the scale is hard to wrap your head around. They're building 10 in Thailand, 2 million square feet.
2 million, so that's what, like 35 football fields of factory space?
Something like that. And they're accelerating the timeline. They want the first chunk of it ready by June of this year. They're rushing. And they're doing it all with zero debt.
Wow.
Nearly $1 billion in cash on the balance sheet.
Which brings us to the homeless CEO story. This was the moment in the call that made me sit up. Tell us what happened at Pinehurst.
It was almost a throwaway comment, but it reveals everything. The CFO was talking about capacity constraints, and he joked that the CEO, Seamus Grady, doesn't have an office anymore.
Because they kicked him out.
Because they needed the space for machines. They are literally converting office space and warehouses into manufacturing floors. They're evicting their own executives.
I just love that visual. The CEO of a multi-billion-dollar company is probably sitting at a folding table in the hallway because a robotic arm needed his corner office.
It's funny, but it's also the ultimate signal. When you are stripping the carpet out of the boardroom to pour concrete for assembly lines, you aren't guessing about demand. You're drowning in it.
It's the opposite of a vanity project.
Exactly. And their return on invested capital is around 40%. So building factories is the absolute best use of their cash. Every square foot they give to a machine prints money.
So let's try to put this all together. Growing 36%, supply constrained, not demand constrained. They're building 35 football fields of factory space. And the stock is down 17%.
It is the disconnect of the year so far.
But there had to be something bad, right? Some little goblin in the footnotes.
Well, if you squint, you can find a nitpick. There was a small $3 million foreign exchange loss.
Okay.
And they mentioned effects might be a 20 to 30 basis point drag on gross margin in Q3.
20 basis points. That's 0.2%. That's a rounding error.
In a rational market, yes. But in a nervous market, looking for an excuse to sell a stock that's up 87%, it's enough. Traders see margin headwind and just hit the sell button.
So it's a classic sell the news event. The actual supercycle thesis seems completely intact.
I'd argue the thesis is stronger today than it was yesterday. The valuation is just lower. Management is voting with their capital, putting hundreds of millions on the line because they see the orders coming.
It's a fascinating setup. You have this massive divergence between the stock price and the business reality.
And that's usually where opportunity lives.
Which brings us perfectly to our favorite segment of the show. We've looked at the numbers, we've analyzed the strategy. Now it's time to get a little creative.
Let's do it.
It is time for This Is Not Financial Advice.
Disclaimer. We are just voices in your headphones. Do not trade based on the furniture arrangements of C-suite executives.
But maybe you should, because today's idea is inspired by Seamus Grady's missing desk. I call this the concrete over carpet pair trade.
I like the sound of that. Break it down for me.
Okay, the long side of the trade is obviously Fabrinet, ticker FN, and the thesis is the homeless CEO indicator. You want to own companies where demand is so urgent, they are literally stripping the carpet out to pour concrete for machines.
It's the ultimate sign of tangible value. If the CEO still has the mahogany desk, maybe they aren't growing fast enough.
Exactly. The stock is down 16% on valuation concerns, but the business is growing 36%, and they physically cannot build fast enough. You go long FN.
Okay, I'm with you on the concrete. What are we shorting?
You short the carpet companies. You look for these pure play AI software companies, the ones with price to sales ratios of 50 or 60 that have really, really nice offices.
The ones with the kombucha taps and the nap pods.
Yes. If they're spending money on aesthetics and have plenty of empty office space for creative thinking, you short them. We're betting on the physical infrastructure of AI.
Which is clearly scarce.
Versus the hypothetical application layer, which is overhyped. It's a hard assets versus vaporware trade. If a robotic arm took the CEO's office, you buy. If the CEO is posting photos of their new ergonomic chair, you sell.
The concrete over carpet play. I like it. It's a wild theory, but looking at Fabrinet's backlog, it might just work.
All right, let's wrap this up. Recap for everyone who might be terrified by the red on their screen.
Fabrinet delivered a record quarter. They confirmed the HPC ramp is real and heading toward a $150 million quarterly run rate. And they are building 2 million square feet of factory space because they simply cannot make this stuff fast enough.
And the market responded by putting the stock on a 17% discount rack.
The market hates the price today, but the business loves the demand. And in the long run, demand usually wins. That disconnect between price and value is as wide as I've seen it in a long time.
That's the bottom line. Fabrinet is building the roads for the AI superhighway, even if the toll booth collectors are on a lunch break today. Thanks for tuning in to Talk Tickers.
Keep watching the tickers.